An extra $300 a month on a $300,000 mortgage? That sounds like a drop in the bucket. Is it? Send that $300 the right way. And on a typical loan at today's rate, it wipes out 9 full years of payments and keeps you about $135,000 of interest on your side of the table instead of the bank's. No refinance, no trick from the internet, no catch. Just the math the bank hopes you never run. I'm a licensed mortgage broker. In the next few minutes, I'm going to show you exactly what happens the moment your extra $300 hits the loan. Where every dollar goes, what your balance looks like after 5 years, and after 10 years, and the exact day your mortgage dies. I'll also show you the one mistake that makes your extra money do absolutely nothing. And it happens to real people every single month. And stick around for the payment ladder near the end. From $100 a month to $1,000 a month. So you pick the number that actually fits your life. Let's get into it. Quick note before the numbers. I'm a licensed mortgage broker, but this is education, not financial advice for your exact situation. I'm using clean, round numbers today. A $300,000 loan, 30 years fixed at 6.5%. So you can see how the machine works. Your balance and your rate will be a little different, and that's fine because the math works exactly the same way. And near the end, I'll show you how to run every one of these numbers on your own loan in about 30 seconds. Oh, and one quick before we start. Tap that like button for me. It costs you nothing and it takes 1 second and it generally helps my channel. Okay, let me show you what you're up against. Here's the setup. $300,000 loan, 30-year fixed, 6.5%. The payment, just principal and interest, comes to about $18.96 a month. Now let me show you the part that makes people's stomach drop. Out of your first payment, almost $1,900. How much do you think actually pays down your loan? $271. That's it. The other $1,625 is pure interest. You wrote a check for nearly $1,900 and you bought $271 of your house. And I want you to see why. Because this whole game, every month, the bank takes the balance, multiplies it by the rate, and divides it by 12. $300,000 times 6.5% divided by 12 is $1,625. That's the interest slice. And it comes off the top of your payment before a single penny touches your balance. And because the balance barely moves in the earlier years, the interest slice barely shrinks. That's what front-loaded means. It's not a scam. It's just math working against you while the balance is big. Run this loan for the full 30 years and you'll hand the bank back around $382,000 in interest on a $300,000 loan. All in, you pay the bank back $682,000. That's the plan the bank printed for you the day you sign. Now watch your little $300 does. Here's the move. You keep making your normal payment exactly like always, and you add $300 marked applied to principal. Those 3 words matter, and we're coming back to them. That extra $300 skips the interest line completely. The interest for the month is already covered by your regular payment. So every single one of those $300 slams straight into the balance. Now think about that, what that means on day one. Your full $1,896 payment moved the balance $271. Your little $300 ad moved it $300. The extra money is doing more principal work than your entire regular payment. That is not a drop in the bucket. That's a second bucket. And here's where it starts to snowball. Next month, your balance is lower than the bank's schedule expected. So the interest slice is a little smaller. So more of your regular payments goes through to principal too. Your dollars don't just work once. They quickly shrink every single charge for the rest of the loan. At 6.5%, one extra dollar sent in year one erases $3 of future interest by the time the loan dies. Early money is the strongest money you'll ever send. Real quick, because you've had this loan for a few years and nobody showed you that $271 split. I know exactly what you're feeling right now. And that feeling is why I make these videos. If something just clicked, tap the like button. And if you want more plain English math like this, hit subscribe while you're at it. Here's the honest reason I ask. This channel is still small, and every single like and every subscribe tells YouTube to show this video to the next homeowner, starting at a statement, wondering where all their money goes. It's free. It takes 1 second, and it's the biggest thing you can do to keep these coming. Okay, let's fly down the timeline because you need to see this thing compound. Year 5. On the bank schedule, after 60 payments, that's more than $113,000 out of your pocket, and you still owe $281,000. With extra $300, you owe just under $260,000. You're $21,000 ahead, and every one of those dollars is equity you own. Year 10, the bank schedule says you still owe $254,000. You just under $204,000, $50,000 ahead. Now we're picking up speed. Because remember, every dollar of that head start is also killing interest charge every single month. And then comes the day the bank schedule never saw coming. Month 250, 20 years and 10 months in, your balance is zero. The original schedule still had 9 years and 2 months to go. That's 110 more payments at $18.96 a month that you just never make. So let's do the final scoreboard. On the bank's plan, you pay about $382,000 of interest. On your plan, $247,000. You keep $135,000. And what did it cost you to get there? $300 a month for those 20 years. Call it $75,000 total. And every dime of that $75,000 went into your own house, your own equity. It was never spent. It was just parked early. You parked $75,000 in your walls, and it depleted $135,000 of pure cost. There is no coupon on earth like that. Now, the mistake. Because this part generally hurts, and it happens every day. You spend an extra $300, you feel great, and your mortgage servicer applies it an early payment next month, or parks it in your escrow account, and your payoff date does not move 1 single inch. Extra money to the bank has a default setting, and the default is not in your favor. So write this down, 3 rules. Rule number 1, mark the money principal only. In your payment portal, there's usually a box for it. On a check, it goes on the memo line. Rule 2, check your very next statement and make sure the balance dropped by your normal principal plus your extra $300. If it didn't, call them. It's a 5-minute fix. Rule 3, extra means extra. On top of your regular payment, never instead of it. Now, maybe $300 isn't your number, so here's the ladder. Same loan, same rate, pick your rung. An extra $100 a month pays the house off 4 years early and saves you $61,000. $100, that's streaming services money, and it's worth $61,000. An extra $200, almost 7 years early, saves you $103,000. $300, Our star today, 9 years early, saves you $135,000. $500, you're done in 17 and a half years and keep almost $180,000. And a full extra $1,000 a month kills a 30-year mortgage in under 13 years and saves you $241,000. Every single rung wins. Pick the one you can actually hold. And here's the honest part most people miss. The dial goes both ways. Tight month, skip it. Nothing happens. No penalty, no phone call, no drama. Your required payment never changed. That flexibility is exactly why I'd rather see you sending $300 a month that's flexible than locked in a refinance payment you can't afford to miss when life happens. One more move for anyone who's budgeted says there's no room at all. The sneaky extra payment, pay half your mortgage payment every 2 weeks instead of once a month. A year has 52 weeks, so you quietly sneak in one full extra payment every year, about $160 a month on this loan without ever really filling it. That trick alone pays the house off almost 6 years early and saves you $87,000. One flag though, do it yourself for free by just sending the extra principal. If your servicer offers you a biweekly program with a setup fee or a monthly charge, skip it. You can do the exact same thing for $0. Fine print. Because some of you should not send that $300 to your mortgage yet. 3 boxes have to be checked first. Box 1, your high interest rate debt is dead. If you're carrying a credit card at 24%, paying an extra on a 6.5% mortgage is math malpractice. Kill the card first. Box 2, you have a real emergency fund, 3 to 6 months of expenses, because extra mortgage money goes into the walls and the walls do not give it back when the car dies. Remember, paying ahead never lowers your required payment. The bank still wants the full $18.96 a month, no matter how far ahead you are. Box 3, you're grabbing your full employer match in your retirement account because that's an instant 100% return, and nothing in this video beats it. And yes, some of you are already yelling at the screen. Just invest the $300 in the market. The market averages more than 6.5%. That is a real debate, and I've made whole videos on it. They'll be on the end screen when we're done. The short version, extra principal is guaranteed return of exactly your rate. Tax-free, sleep at night, money. The market's average is higher, but it's an average, not a promise. Both can be right. This video for the money you've already decided the house gets. And let me leave you at the finish line because this is a part nobody talks about. Month 251. For the first time in 21 years, no mortgage payment leaves the account. You just gave yourself an extra $18.96 a month raise. That's almost $23,000 a year, 9 years ahead of schedule. That's college money, that's retire early money, and if the bug bites you, that's a down payment on a rental property every couple of years, which is the other half of this channel, and honestly, the fun half. I even wrote a book about financing rentals. DSCR loans made simple. It's on Amazon, link down below. That's where you're going next. So here's the whole thing on one page. A $300,000 loan at 6.5% wants $682,000 from you. An extra $300 a month marked principal only cuts 9 years off of the loan. It keeps $135,000 of that home. Check your next statement so the money actually lands on principal, and pick your rung on the ladder. 100, 300, 1,000, every rung wins. What your own numbers? Grab the last statement, take the balance, multiply it by your rate, divide by 12. That's this month's interest lies. And now you know why the early years feel so slow. Then open any mortgage calculator with an extra payment box. Type in your loan amount and your extra amount, and it will hand your own version of everything I showed you today in about 30 seconds. Do it tonight. It might be the most profitable 30 seconds of your year. And remember, this is education, not personalized advice. Everybody's loan rate and budget are different. So before you move real money, talk to a licensed pro. This is generally what I do all day. Now, before you go, I'll ask you straight. If this video showed you something about your own mortgage that nobody ever explained to you, hit that like button and subscribe to the channel. I don't say that as a throwaway line. This channel is still small, and every single like and every subscribe tells YouTube to show this to the next homeowner who thinks an extra $300 can't possibly matter against a $300,000 loan. That person might be someone you know. So if I've earned it today, tap the like button, hit subscribe, and drop me a comment with your wrong. 100, 300, 500, whatever your number is picking. And I'll tell you roughly what it saves you. I read every single one. I'll see you in the next one.